Hey traders, this is Blake Morrow with Trader Summit, and with me is Jim Welsh. We're doing this a little bit early because some scheduling conflicts, but Jim, we're hot off the Trader Summit event. If you guys and gals missed that, we actually had you as a guest, and you came in and swung for the fences and hit it out of the park. It was great to have you there, Jim.
Thank you. I was glad to be a participant, and it feels weird. It's Wednesday, not Friday. Like it's kind of like, what's happening?
A little bit of conflicts with our schedules, but it's great to have you here and kind of following up, what you had talked about at the event. But we are also seeing a rally in stocks. We're seeing the dollar finally pull back. I know you've been looking at bonds and looking for a bottom to be forming in bonds and TLT. We're going to go in that as well. But yeah. So how do you feel about the markets where we're at right now?
Well, what really was the pivot that provided, at least for the markets, not for the Fed, but for the markets, was the story on Friday morning in the Wall Street Journal by the guy, the Fed whisperer, who the Fed has used in prior months to kind of, when they can't say something or there's an immediacy necessary, they use the Wall Street Journal reporter. And what he said is, yeah, they're going to be debating what the magnitude of the rate increase at the December meeting, because it's pretty much locked in at 75 on November 2nd. And so just opening that door a crack that, oh, right, they might think about this. And this is something you and I talked about October 14th, because I said Lionel Brainerd had made a speech, made some comments. My expectation was that they would do it after the November 2nd meeting. But for some reasons that I think we'll talk about briefly here, they felt compelled to kind of rush and do it last Friday. And so the market looked, oh my goodness, the Fed might only go 50 basis points in December. So we've seen the dollar come off. We've seen bonds didn't respond that enthusiastically on Friday, but they sure did yesterday and have followed through. And obviously the stock market has rallied as well. So
this is your chart that this is kind of suggesting there was a lot of disbelievers over overbelievers, right?
Yeah, I mean, well, what you have basically and we've talked about this for months and months this year, Wall Street has doubted that the FOMC was in fact going to raise the rate aggressively to neutral, that they would then raise rates to a restrictive level and then hold it there for a long time. But all of a sudden, and the Fed funds futures were always kind of behind whatever the Fed was saying. And suddenly, over the last week or two, the Fed funds futures have kind of run ahead of the Fed. So the Fed in September said, yeah, we're going to 4.6 and then we're going to hold it there. The Fed funds futures last Thursday traded above 5% for April. So my point is kind of a crazy shift. And this kind of stuff where markets don't pay attention or disbelieve, and then suddenly not only do they believe, they become overbelievers, is something that kind of happens near trend changes. So that to me was the significance of Friday and where the markets were, because they were running ahead of what the Fed was likely to do. In other words, they didn't believe inflation was going to force the Fed to do all this hiking. And then suddenly, oh no, the Fed's going to have to do even more because inflation is so bad. And the irony is that we are on the cusp of seeing inflation come down over the next 6 months, and I think a fairly aggressive way.
All right. Well, what does that mean for the FOMC? And I mean, we've got about a week before the FOMC. Now we got the ECB that's coming up here this week. Hopefully you might be watching this ahead of the ECB, but what are we expecting out of next week? I mean, how's the Fed going to react here?
Okay, so this just shows they have a blackout period 10 days before a meeting, which kicked in on Saturday. So the timing of the Wall Street Journal article, plus, is we've talked about it, the Fed has unusually been speaking where the most dovish guy, Kashkari, sounded just like Bullard, who's the most hawkish guy on the FOMC. Suddenly on Friday afternoon, Mary Daly, who's the San Francisco Fed, who's normally a dove, but has been talking very hawkishly, said, we're going to have to balance if we raise rates too hard, too quickly, and, causing a recession versus, geez, not raising rates enough and taming inflation. But again, it's just the shift in the divergence suddenly appearing. And then also on Friday, as you well know, the Bank of Japan came in and intervened to support the yen. The dollar dropped from 152, I think, to about 145. All of this happened on the same day. It's not a coincidence, all right? So to me, what it meant was that financial conditions were tightening too much. We saw what the bond market did last week. It got hammered. Treasury bonds are down 12 weeks in a row. That has never happened since 1977.
Wow.
Equities were weak. The dollar was really strong. So I think the Fed felt they couldn't wait to after the November 2nd meeting. They had to move more quickly because financial conditions were kind of running out of control. That's why they planted the Wall Street Journal article. They had Mary Daly make a speech and kind of temper some of the comments. And then, of course, the Bank of Japan was doing it because, they've been asleep at the wheel for months.
Right.
So,
well, talk to us how bonds are going to react, because you've been calling for like this low in the TLT, and it seems like yields are starting to come off now. So what are your thoughts with TLT moving forward?
Okay. So if we go to the next slide, you did, well, man, you are quick.
On it.
Yeah. So I obviously early, because I was average price on my recommendation is about 103 on TLT, and it kept going down. Two things came into, and the reason why I recommended it was, where are we going to be in the first quarter? The Fed somewhere along the line was going to downshift. We're going to see GDP slow in coming months. We're going to talk on that in a second. And then CPI is going to drop aggressively. As I said, I think it could be near 5% by the time we get into March. So those are all the reasons why I felt, hey, if I go out 6 months, I think we're going to get a tailwind. What kind of, as I said, best laid plans? Yeah, but I didn't know that the Britons were going to do a tax cut program. The British gilt yields jumped 130 basis points, pulling up the Treasury yield. Dollar strength. What's happened is, and I've written about this, how the dollar is exporting inflation. So as the dollar goes up, other currencies go down. So for a lot of emerging market countries that buy food and energy, because they don't produce all of that they need domestically, hey, food and energy prices are higher. But if their currency is down 10%, it adds another 10% to the cost, pushing up inflation in a lot of countries. And then the central banks around the world have been forced to raise interest rates to defend their currency. And I think what we saw in the last week or two is all of the central banks have foreign currency reserves. They're going to have them in the dollar. So you get to a point where they're trying to sell dollars, but they need to generate, if you will, dollars to do that. They would take their treasury holdings, sell them, use the proceeds then to sell dollars and buy their own currency. And I think some of that weakness that we saw last week was due to this. So, technically, obviously not fun. I usually don't have trades that go this far against me, but I thought that things were just getting so stretched, and my conviction has been bolstered by, hey, what is really coming? So we'll see what happens.
And here's your chart showing you an example of what you're looking at. What is that trend line or that moving average that's capping the market at the moment?
That is probably a 13-day moving average. The green line is the 13-day.
Got it.
But you do have an island reversal so far in place, where you had a gap down on TLT on Thursday and Friday, then a gap up on Monday. That potentially is a very bullish pattern if it continues to hold. Now, there's a GDP report that's coming out tomorrow, Blake, for the third quarter. And as I've discussed and written about, there's a good chance, it definitely is going to be positive. There's a chance it's going to be above 2%. So there's, I think, the risk tomorrow morning when they come out with this GDP report. We've seen stocks rallies, the dollar sell off, and the bond rally kick in, all predicated on, hey, maybe the Fed will only go 50 basis points instead of 75 at the December meeting. A strong GDP report may get some people to think, whoa, maybe they won't be able to do that. So I expect a pullback in TLT, a bounce in the dollar, and a decline in the S&P if I'm right about all this.
Well, if you are right about it, let's see what you're looking at, because the next chart you have is the S&P. So explain to us in detail what you're thinking here.
So 2 or 3 weeks ago, we were talking, right after October 14th, My expectation was that we were going to get a rally. We would see a pullback. I sent out a special report actually on, I think it was the 13th of October, and a pullback to 3580, and then a rally to 3800. And that was just using, basic, hey, a rally 220 points, pull back to 3580 was just based on chart analysis. Add 220 to 3580, voila, you at 3800. We've gone beyond that. We're coming up to resistance near 3900. And as I noted, hey, I think the GDP report might cause a little bit of a pullback and some profit taking. The S&P, I think, will drop under 3,800, maybe drop towards 3,750. The key, because after that pullback, I think we're going to have a stronger move to the upside. The key is the S&P has to hold above 3647. My expectation is that it will, but you got to draw a line in the sand, and this is, I think, it for the S&P, what's necessary. One other thing I'll mention, November 14th is the CPI report for the month of October. So in September, the headline CPI dropped from 8.3 to 8.2. In September of 2021, it was up 41 basis points. So what happens, and we've talked about this, Blake, is the September CPI, then they subtracted 41 basis points from last year and then added 30 basis points for September of 2022. So that net difference, -1, meant that it would drop from 8.3 to 8.2. So if you get another 0.3% increase in the CPI for the month of October, the takeaway value from October of last year is 87 basis points. So I think there's a real good chance that when the CPI comes out on November 14th, that we'll see a number under 8%. It could be 7.8, but it doesn't matter. Just having a 7 handle, I think, will be like, whoa, like it's a wake-up call.
Yeah.
And that's one of the reasons why I think, irrespective of near-term gyrations, I think the market's going to head higher. The other thing is the election, November 8th. If the Republicans get the House, which seems pretty likely, I think, and I'm not trying to take political sides here.
Of course.
Okay, so part of inflation has been Putin war, as Biden likes to call it, but no question in terms of the amount of money that the U.S. government sent out, demand pushed limited supply. So at this point in time, if the Republicans get the House, that means no more spending or additional spending, which means less demand, which more importantly means it makes the Fed's job maybe a little bit easier, that you're not going to get some additional spending that would goose the economy and goose inflation. So if the House goes to the Republicans, I think on balance, the financial markets will look at that favorably, not so much because of who won, but because how it will impact monetary policy in the next 6 months or so. So.
All right. Well, okay. So to explain to us how that affects the dollar, because the dollar has been like on a war path as of recently. And, everybody was, I have to say, everybody was leaning into a stronger dollar, continued stronger dollar. But, all good things do seem like they do come to an end, right, Jim?
Absolutely. They do. Unfortunately, when they're really good things, in the conference this weekend, the summit, I talked about the dollar and how in the summer of 2021, my expectation was that monetary policy would shift. The dollar would rally from 90 to about 103. And what I talked about was, hey, what's coming is the realization that the Fed is going to downshift. And at some point in time, they're going to hit the terminal rate. So to the extent that that has been strengthening the dollar, we're going to see that shift take place. And I think we're seeing it come out in spades. The one thing that was missing was technically, we really needed to see a breakdown in the dollar index. The highs kept getting higher and the lows kept getting higher. Finally, yesterday, you took out that trend line. And more importantly, today, you're trading under 110. Yeah. And that to me was the important thing, taking out that prior low at 110.05. So we're short-term oversold. Again, if the GDP report comes out and it's a little stronger, it's a perfect excuse for the dollar to bounce back, maybe toward the underside of that rising trend line before it resumes the decline.
Okay. But it hasn't translated to gold, because Gold has just, I mean, I know you're, you know, you would think a bottom would be in gold, but it's really just been kind of trudging around here. So what are your thoughts with it?
Well, again, my expectation was as long as we held above that low about 3-4 weeks ago at 16.16, it traded down to 16.18, that we were going to see a rally above 17.28. That's where that little A is. The pullback would then be a B, and a rally above 17.28 would be wave C. Now, if the dollar pulls back as expected, potentially this can rally up towards the 1775, towards 1800. You know, again, at some point in time, we need to hear more Fed speakers talking about cutting back on rate increases and so forth. So I just think that it's the right time to be long gold. We're going to see more upside, and then we got to take it one day at a time.
All right. Well, the last chart you brought up was EM bonds. So tell us what you're thinking here with emerging markets.
Okay. Two things are happening, obviously. As the Fed does gradually move to lower magnitude rate increases and ultimately getting to the pause button that may be months away, the dollar going through a deeper correction, that's going to be a boon for emerging market bonds, because you're going to get a you know, kind of a double good whammy. As yields ease in the U.S., they're going to come down in emerging markets. As the Fed downshifts policy, emerging market central banks won't be forced to continue to raise rates. So as the dollar comes down, it'll give a boost from a currency translation to emerging market bonds, and they yield very attractively, 5.36%. That's comfortably above what you can get on a lot of things. So to me, this is, and then lastly, technically at the bottom part, you can see the RSI had a very significant positive divergence when EMB last week made a lower low. So again, I wouldn't buy it today. I would wait for that GDP report, because I think we're going to see all the markets kind of react negatively, because it maybe throws a little cold water on the idea that the Fed will do 50 basis points in December.
But who knows, right? And we got to wait for the data. Jim, hey, I want to thank you for putting it all together for us. It was great seeing you at the event, and I think you really, for those of you that didn't get an opportunity to see Jim, but you did register for the Trader Summit event, make sure you do watch the recordings, which will be out hopefully, you know, here in the next few days. Everything's going through editing. But Jim, I want to thank you for spending your time with us every week. How do I find out more about what Jim Welsh does?
macrotides.com, or send me an email, jimwelsh.macro@gmail.com, and I'll send you the most recent weekly technical review.
Awesome, Jim. Well, thanks for spending your time with us. We do appreciate it here at the Trader Summit community. I'll look forward to speaking with you next week for sure.
Sounds good, Blake. Thank you. Have a wonderful mini vacation.
Thanks. Take care. Bye-bye. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.